Hello and welcome to Bazaar Ki Baat. Apart from our normal discussion on market and sector update, today we are also going to throw some light on a research study which shows how investors tend to underperform largely because of their selling decisions. Continuing from our last month's discussion, we are also going to talk about how debt funds continue to be favorable over bank fixed deposits from a tax deferral point of view. Before we begin, we would want to put out a disclaimer that this is not a financial advice and is purely meant for knowledge dissemination purposes. Indian equities soared in April. We saw the S&P BSE Sensex move up around 3.6% and Nifty 50 move up around 4%. Unlike many months, mid and small caps also did better. We saw the BSE mid cap and small cap indices surging 5.9 and 7.3% respectively. Let me bring in Kshitij here. Kshitij, what is your view on what really triggered the market last month and how did it really pan out for the overall market in India and globally?
Yeah, so as you said, April was a good month for the markets and broader markets also, not just for Nifty 50 or the large cap sector. So the major reason to my mind for this was that FPI's made a comeback. FPI infused around 1.4 billion in April 2023. March was also a positive month for FPI, but that could be largely attributed to the Adani GQG deal, which made a larger portion of the total inflow. To put into perspective, FPI's had an outflow in the year 2022 to the tune of 16 billion in equities. So from that perspective, they had a continuous outflow throughout the year of 2022. So any inflow when they come back in large amount, it will be positive for the equity market. The underlying reason for this comeback can be attributed to RBI MPC decision to hold the rates at 6.5%. This was against popular expectation, but RBI decided to take that risk, and it kind of raised hopes among market participants that we may be, if not at the peak, at least close to the peak of interest rate cycle, and we may soon see the interest rate cycle turn. And this led to the FPI inflows to rate sensitive sectors such as banks, NBFCs, auto stocks. There were some concerns over the tepid outlook given by the IT companies, but the rate sensitive sectors took the market to newer highs. Uh, even other larger companies like Reliance, HUL, they also delivered better than expected numbers. So that also contributed. One of the reason I would say globally for which could have triggered the FPI inflows is that we saw weakness in dollar index, right? So dollar is kind of the reserve currency for the world. So any weakness there kind of boosts the other assets because everything is valued against dollar. So we had a we rupee was very well held at 81.5 levels, and this also gave confidence to FPI that their dollar yields, which matters to them, not the INR yields, dollar yields would be positive for on their equity investments. And if we talk about the global markets, the banking crisis is far from over, in my view. There are global consumers are also wary of spending. So that's the reason we saw IT companies giving such tepid outlook for the coming year. And US GDP growth also we saw sharply lower for in March 2023 quarter. And we should see a visible impact of this on the Indian exports, technology spending, and pricing power of certain export companies. So globally, things are still looking weak, but India continues to shine. Yeah.
Certainly. When we look at the sectoral side of things, we see that there was quite a bit of divergence in April. PSU, realty, auto, they outperformed. IT, like you just mentioned, because of the global uncertainties, continues to underperform. Amongst the factor indices, also, we saw that it was an excellent month for momentum as well as value. What do you think is driving the divergence in the sectoral performance? What are the key, boosters for some of these sectors that are doing well?
Yeah, so you hit the nail there in the sense the rate sensitive sectors did well. They were the top gaining sectors, and this is not hard to fathom, as we've already discussed that RBI status quo on rates kind of boosted these sectors, and the expectation that we are maybe very close to the top. So be it any sectors which are debt heavy like infrastructure, oil, metals, they also benefited from this expectation of rate hike cycle ending. The IT sector was the laggard expectedly because we guidance from the bellwether companies like Infosys and HCL Tech. TCS also, though do not give out guidance, but they but the this in the I would say they also looked the management also looked not that positive about the future outlook. From a style perspective, one thing which I would like to say is that if we look at the broader picture, value made a comeback say after COVID, largely because of the reason that value is largely concentrated into sectors which are cyclical. This is because they were cheap and like auto, metals, PSU, and when the whole market was doing well, these sectors kind of did very well. So value add as a factor did well when the whole market was, the whole economic environment was booming, right? But now that that thing has that COVID recovery has happened, my sense is that we might again see a comeback of growth plus quality factor. The reason being because now that not every sector is going to perform, we will see companies which have stable earnings and more balance sheet strength to weather the storm will start doing well. So that is my feeling that we might see that churn from value strategy to a quality momentum strategy, which quality plus growth strategy, which was not doing so well as compared to in the last 2 3 years. But I think we might see a comeback now.
Yeah. All right. Kshitij, coming back to the core topic today, you had
Right.
recently written about this study which, talks about how investors tend to underperform because their selling decisions are not right. We tend to talk to so many people, and we always talk about buying decisions, the kind of stocks that people are buying.
Mhm.
But this study was an eye opener by moving the focus to the selling decisions. Would you like to throw
Right.
some light and give us a brief idea of what this study talks about and how is it relevant to individual investors like you and me?
So one thing is that this study kind of documents a striking pattern in the investor world, which is while investors display a clear skill in buying, right? In the sense their buying decisions are outperforming their existing portfolio or a random buying in their existing portfolio or the index also, but their selling decisions underperform substantially. So this was the underlying outcome of that study. The study is quite comprehensive. Around 750 million transactions being has been studied over a period of more than 10 to 15 years. So it's quite comprehensive study based on institutional investors. So it's not like retail data, which could have any several reasons. For institutional investors, the reason would be there is something underlying amiss, right? In the sense, it's not like some retail feeling or behavior change has happened. So what it documents is that one thing which is very clear is that it's not like they lack the skill to sell, because the study also says that if the selling is happening close to the announcement dates, right? In the sense, if there is an earning announcement or a balance sheet has come out, or or some news has come out, that those kind of decisions have outperformed by 150 bips, right, annually. But the decisions which are not on non-announcement date, or where there is no other information available, those decisions are not performing well. So the skill is there, right? If you give me the data, if the investors have the data available with them, they are being able to decide which stock to sell, right? But if it's during the year, anytime else during the year, they are not focusing so much on the selling, right? So the what the study says is that if a person has added positions, right, which if it's bought positions, those positions outperform by 100 bips annually to the existing portfolio, and also the index, right, the benchmark. And while in contrast, when if they sell, they not only fail to beat the no random selling strategy, but also underperform the benchmark substantially. So 80 bips is a very substantial number over a long period. So the study found that this underperformance is primarily among fundamental oriented managers, which means there are two things which it means is that uh, maybe there are fewer procedures in place to systematically process information about existing holdings, right? Or secondly, the focus as a whole of the industry is on buying decisions, right? If a new client comes in, he's only asking you about the buying decisions, and which we have also seen. They are not focused on something which has been sold. And why I say that it is very important to focus on selling is that uh, the study also talks about it, is that once you sell a stock, right? It first of all, it changes your weights in your current portfolio. So your portfolio gets concentrated into certain stocks, which may be beneficial, may not be beneficial, and may lead to. And secondly, what happens is once a fundamental manager sells a position, it it is empirically known that it's less likely to come back in his portfolio. So once you have sold a position, you kind of that stock goes out of your future basket of interest. So that is the important. That is why it is very important to focus on selling decisions. One style which has performed well expectedly is the momentum strategies, because they have a clear cut selling exit strategy. So this was one of the things which I found very interesting. So fundamental managers can actually take some cues from momentum factors or build up their own strategies to exit, which is very important. And for an individual investor, it is as important to have a selling strategy as a buying as opposed to a buying strategy, because as we have seen, even selling makes you underperform a lot if your selling decisions are not proper. This paper was called "Selling Fast and Buying Slow," and heuristics and trading performance of institutional investors. And if anybody is interested, they can go and read it. So my 2 cents is that selling is as important as buying, if not more so. So
Yeah, while
that
while this paper I think focuses on institutional investors, I think it is kind of a reality check for a lot of individual investors also. In my experience, the kind of investors I have spoken to, a lot of them start buying stocks and building up their stock portfolio. But I think, I mean, I've seen a lot of portfolios with even 50 and 70 stocks. And one of the burning questions on their mind is, what do we do with it? I mean, like you said, there are no systematic processes to identify the right time to sell. And I think that's also
Right.
because everybody has a different reason why they buy, when somebody is following a pure fundamental strategy. So I think it's an
Mhm.
interesting point to focus on even as individual investors. Thank you so much,
Agree.
Kshitij.
Agree. Yeah.
Moving on, last month we had spoken about the change in taxation for debt funds, and Vikas had thrown some light on what the change looks like and what does it mean for individual investors. This month we have done some numbers around how taxation really pans out. And what we realized is that with a deferred taxation point of view, debt funds might still score over bank FDs. Let me invite Vikas to throw some light on this aspect and take us through the numbers to show how does it reflect on individual portfolios. Vikas, would you want to take this up?
Hi, Shruti. So last month we had discussed that uh, deferred taxation is one of the important aspects which all investors should keep in mind. This was earlier applicable for your equity investments. Now it is applicable to your debt investments because you don't get indexation benefit. When we run through numbers, I will just take you through the numbers like in a like slowly so that you can understand that how does it impact your returns and the actual gains that you make out of debt fund. So I have taken an example where somebody, if he invests 10 lakh rupees in an FD versus a fixed deposit, the rate of interest is assumed as same. So we have kept the rate of interest same. In a FD, what happens is whatever interest that is accrued, it is taxed as per your slab rate on the year of accrual. So you have to keep in mind that even if you are doing an FD for 5 years, the interest is not paid out to you, but still on accrual basis, you will be taxed. So if we go through the numbers slowly, we see that year one, what will happen is on a 10 lakh capital, you will generate 80,000 rupees of interest. On that, you will be charged 30% taxation. For people who are having surcharge and other things, it would be higher. So we have taken like people like 30% flat taxes because to keep it simple. So it can be slightly higher for people who are having surcharge, but for normal anybody who is in like 30% tax slab, it will be approximately 24,000. Now what happens is that at the end of year one, the capital which is available for reinvestment is now 10 lakh 56,000. However, in a debt fund, you have 10 lakh 80,000 as the capital which is now earning interest for you. So this is an important aspect in personal finance, which adds up as you are invested in an instrument for the long term. Then next year, the interest, if you see the year two interest on the debt fund, it will be at similar rates would be 86,400. However, on an FD, it will again be lower. So year two, you see that FD is generating 84,480. However, a debt fund is generating 86,400. So there's a 2,000 rupees extra income which is generated. And this again will get compounded in year three. So if post-tax you see now the figure is 93,000, so now the difference is 4,000. So the point that we are trying to make over here is with every passing year, the deferred taxes adds up to your returns. And it may be a small number in the initial years, but if you stay invested in an instrument, then this deferred taxes becomes a huge number. So even in a 10,000, like 10 lakh rupees investment, you generate a alpha of 364, which is a 1.5% extra return over 5 years. So this is like a subject which a lot of people avoid and they do not like appreciate the fact of deferred taxes. So
So I think that a larger impact is being made for people who have bigger portfolios and are looking to invest for a longer period of time, because we know a lot of families who have such large amounts in bank deposits which keep lying there for 10, 15, 20 years. Even though this difference is not intuitively so visible, I think the fact that a subtle compounding benefit is taking over into deferred taxation really adds up, right, because this is what you are trying to focus on.
yeah. And it can be a part of like say a lot of people want to do some allocation to debt for the long term financial goals also. For them, this makes sense because you don't pay taxes every year. There are other things also about deferred taxation, which is that one thing which I wanted to mention specifically is that a lot of people in their 50s are who are nearing retirement. What happens is that if they are making FDs, they will be taxed on accrual basis. They can use debt fund as a tax planning tool where they invest in this debt funds now. And once post retirement, if they come under lower tax regime, they start redeeming their debt funds. So this can act as a tax planning tool for a lot of people who are nearing retirement, in which they can delay their taxation and they can actually like save a lot of taxes. So this is one thing which I wanted to specifically mention. I was reading a book about deferred taxation, and in that, what happened is that it was like they had compounded this deferred taxation for a very long period. So if you compound 10 lakhs for 30, like 10 lakhs for 30 years at 8%, paying taxes every year, you receive 50 lakhs. However, if you defer your taxes, you receive 70 lakhs. So there's a difference of 20 lakhs, which can be created over a long period of time. Again, this is underappreciated because you do not see the benefit of deferred taxation very specifically. So these are things about deferred taxation which one has to keep in mind before making investments. The very important aspect of indexation is gone, but still deferred taxation can have an impact on investment. So this is what I wanted to talk about.
Yeah, I think the big advantage of indexation has been taken away, but there is no added disadvantage to debt funds, and
Yeah.
your point of deferred taxation clearly makes it the winner. And I think you made a very interesting point around for people who are nearing retirement. For them, of course, from a taxation point of view, they can still take big advantages of debt funds. Thank you, Vikas. Thank you for bringing this to light and making this very clear. This is it from our end at Bazaar Ki Baat. Stay tuned for our next episode next month.